Great to have you with us. And as we were mentioning, the stock market starts this trading day in record territory, but it's an interesting time when it comes to stocks and the economy. On the one hand, as we gear up for the next interest rate decision from the Federal Reserve, there are growing expectations that the Fed will this time be ready to cut. That's been seen as a near-term catalyst for stocks. Of course, there are signs of uncertainty for the U.S. economy that are opening the door for a possible rate cut by the Fed. And we've been increasingly talking about economic uncertainty in Canada. But interestingly, our Canadian stock market at all-time highs is getting a lift in part, as I was mentioning, because there's these long-term projects that the government is now zeroing in on that could be a boost for Canada's economic outlook. Let's get some insight and analysis on all of this now. Earl Davis is head of fixed income and money markets at BMO Global Asset Management. Earl, it's nice to see you.
Always a pleasure. Okay,
let's start with the general mood of the markets, which I would say this week, these continued all-time highs, the catalyst that most people have pointed to is the growing belief the Fed will cut interest rates next week. Maybe the door is even open to more cuts this year with what's perceived to be tame inflation, but also some wobbliness in the jobs market. What's been your interpretation?
Yeah, our interpretation of monetary policy going forward is very constructive of the markets, of risk assets in the markets. And the reason why that is you could actually break down the monetary policy moves into three aspects. One is the obvious interest rate lowering, the easing of interest rates, which is 75 basis points discounted for this year. It means the company's cost of financing, cost of their debt is less. That's more money in shareholders' pockets. The value of that stock or equity goes up. That's one reason. But there's two other reasons that people don't talk about, but they're definitely buoy our view of equity markets and risk assets in general going forward. So the second one is what they call the Fed put. That's because overnight interest rates in the U.S. are 4.5%. If something happens in the world, there's lots of dry powder for the Fed to ease more than the market's discounting. So they could easily go to 2%, 1.5% again. That's significant sort of dry powder for the markets, and that helps, again, profits and whatnot. So if you own an equity and you know that Fed put is there, it makes you feel safer. It makes you want to invest more in the equity markets. So that's one aspect. And here's another thing. Money market accounts, so accounts in the world and in the U.S. in particular that own interest rates 1 year and under, $7 trillion. And they do that because interest rates are 4.5% in the U.S., so they're earning a lot of money there, 4.5%. Once you start easing, it's no longer 4.5%. If they go down to 3%, what you start looking at is, I'm going to get out of my money market account and go into risk assets to earn more money. So there could be a lot of money that flows into risk assets going forward, more so than just today.
It's interesting because, and I don't want to get on a divergent path onto gold, but as you might have seen, Goldman Sachs made the argument that if just 1% of the money in the Treasury market comes out of that market and finds its way not necessarily just into riskier assets, but into gold, maybe we'll be talking about gold 5,000 at some point.
Yeah, and it's actually not a divergent path because now that speaks directly to the Canadian economy. As you said, TSX, record highs. There's two things that are driving that. One is it's not commodities. You know what it is? It's commodity mining companies. They've actually outperformed commodities this year. And part of that is, the infrastructure buildup in Canada. That's going to go to these mining companies, the roads, the infrastructure, everything, the support. So we're very optimistic on Canada as well, like from an equity perspective, economy maybe a bit less so. And it's two things. So one is mining companies and commodities, and the other one is financials.
And correct me if I'm wrong. I mean, stimulus is stimulus. If there is money that is flowing into the materials sector, in part because there's big projects around the world, or if the availability of money improves because central banks are lowering interest rates, I mean, these are all factors that sort of result in a drip into the stock market.
Yes, it does result into the drip. The reason why I bring up the mining companies, for example, and we invest in their bonds, is because the amount of investment and capital expenditures that they have to make is so significant, it even has more impact on them, especially when commodity prices are rising.
Okay. Now, I just want to come back to this idea of the Fed put that you were talking about for a second. I think most of the conversation with the Fed recently, outside of whether they're going to cut next week, which most people think they will, and it sounded like you said 75 basis points for the year.
For the year, yes.
Would not be a surprise to you. But I think most of the conversation got wrapped up in how the White House sort of perceived the Fed's role. So when you talk about a Fed put, is that a Fed put that is influenced by the White House wanting lower interest rates as well, or is that just, you know, a good old-fashioned, the central bank is there to save us all?
No, I think it's separate from the White House, and the Fed put has been there basically since let's call it the Greenspan days, going back to the 90s, and then you had Bernanke, obviously the global financial crisis. The Fed put was put on hold when the focus was inflation. So call it 2022 to 2024. They specifically said, we're focused on inflation. That's our number one focus. So the Fed put was put on hold then. Jackson, at the Jackson Hole conference, Governor Powell, or Fed Chair Powell, I should say, he specifically said we are now focusing on employment markets and not as much on inflation. So that cemented the Fed put being back in play, regardless of the politics outside of the FOMC.
Okay, so we are gearing up for that Fed decision. We're also gearing up for another decision by the Bank of Canada. And right ahead of that, we'll get some inflation numbers for the Canadian economy as well. So you would not be surprised to see the Fed with sort of upwards of 325 basis point cuts between now and the end of 2025. For the Bank of Canada, what do you think they're going to have to do in this environment?
Yeah, we see the exact same path.
So 75 basis points worth of cuts on both sides of the border, or is something you would not be surprised to see?
Exactly. And what we're going to look out for in the statement, we expect them to say 25 and we're data dependent. There might be a slight bias in regards to easing bias, but we don't think the data in 2025 will stop them from easing. 2026 is a different story. We're very constructive on 2026, and that's based off of the U.S. economy with, you know, the big, beautiful bill kicking in there, those tax cuts, deregulation. That will help Canada as well, too, as one of their largest trading partners. So 2025, there's a window for 75 for both Canada and U.S., and we think they'll take advantage of that window.
Okay. Great to get your perspective as always, Earl. Thanks very much for stopping by.
Welcome.
Earl Davis joining us from BMO